You guys are all in for a special treat. Aside from the fact that you're obviously all very interested in the topic, today's presenter is an impeccable class act. Saul Friedman is somebody who is involved in the world of accounting and financing for many, many decades, and he's a sterling reputation as one of the leaders in the industry. And on top of that all, he's an amazing presenter with a tremendous personality and a sense of humor. I'd like to welcome you on behalf of all of the JCon partners to today's JCon conference and seminar. It's really been a lot of work put together to make this an amazing evening. The event is in 3 parts. There's going to be, right now it's a seminar session. There's 4 concurrent seminars. All of them are being recorded, so if your heart is torn between which class you want to participate in, all the recordings will be made available to you. You could watch them. You could watch this class again and again and review it until you become lucky in it. After this class is over, there's going to be the keynote session. Everybody's going to move to the main hallway. Okay, that's where we're going to have Mr. Hertzka from Meridian is going to speak. After he speaks, we're going to do mincha. Then we're going to go outside for dinner, speed mentoring, networking, and enjoying the rest of the evening. So my name is Yoshua Wordy. Nice to meet all of you. And without further ado, I'd like to welcome Saul Friedman. Bruchim habayim, and thank you very
much. Good afternoon. I've been in accounting since 1973. I have a 22-man firm in Brooklyn. We have all kinds of clients. And basically what I'd like to accomplish tonight, I once had a client that interviewed me, and he said to me, Mr. Friedman, I don't want to learn on my own mistakes. I'd like to learn on your clients' mistakes. In other words, somebody who has experience could relate to you things that you should know. Some of it is quite basic. How many people here are not in real estate? Okay. Some of the topics that we're going to cover today quickly are things that they don't pertain only to real estate, they could pertain to regular businesses as well. So let's get going. That's me. Sure, press that sooner. Okay. Okay, this is a 4-part seminar with a couple of tidbits towards the end, and hopefully if I go through this quickly, I'll entertain questions, and if we don't have time for it now, during the eating session, if you want to interrupt yourself and ask me some questions, I'll be glad to answer. Okay. Part 1 is going to be what are some types of real estate financing? Banks are in the business of lending. What are the banks looking for? That's part 1. Part 2, when you're looking for a bank, what should you be looking for? Banking relationships, how it's going to affect your business and how you deal with it. And the 4th and final topic is a very important topic. It's part of the new President Trump's tax law, and that's many of our clients are having problems with this. There's a limitation on deduction of interest expense, which is a very big expense in the real estate industry. Question number 1. Is my property or project financeable? It depends what kind of project you have. The 4 general terms of financing in real estate is 1 is a new acquisition, 2 is a construction loan, 3 is a refinancing of an existing mortgage, and 4 is a bridge loan or what they call a hard money loan. Each of these types of loans have their own purpose and their own requirements. If you're buying a new property, you're financing a new acquisition, the bank will usually give you between 60 and 80% of the purchase price. They will take an appraisal, make sure that it has that value that you're paying for, but they'll usually only give you 60 to 80% of the purchase price since it's a new acquisition. If, however, you like to go with the SBA route, especially if you have a business and you're owner occupied, if you work with the SBA, you can get a loan, maximum loan of $5,350,000, but you have to be a poor person. In other words, you have to qualify for this, so your net worth has to be less than $15 million. If it's less than $15 million, if you work with the SBA, instead of getting 60 to 80%, you can wind up with 90% financing for a building. This is not made for real estate investments. This is made for somebody who has a business and wants to buy a warehouse, a factory, a piece of land, to have trucks on, or whatever. You sometimes go with the SBA route if you're short in cash. They require a lot of paperwork, but for some people it's worth it that they only have to put 10% down. How do we finance new acquisitions? The bank is going to look at a couple of factors. Number one is the net NOI, net operating income, and that's the amount of cash that's going to service the debt. Net operating income is rental income minus rental expenses, and before interest or depreciation or extraordinary items, that's your NOI. Based on that, they're going to finance your building or your property. That's called DSR, DSC, DSR, debt service coverage. They'll want to see a rent roll. Let's say if it's a multi-family house, they'll want to see a rent roll. They're going to want to see the tenant leases. And they're also going to want to see historical, what the tenant vacancy rates are. You can come in here, there's plenty of seats here. They're going to want to see historically what are the tenants' vacancy rates, because they want to project income less tenant vacancy rates for the future, so they'll know how much NOI is left for servicing the building. Depending on the shape of the building, from the loan that you're going to be paying interest on, the bank is going to carve out a reserve that they'll have you keep in a separate account. That's a reserve of cash for one of two things. Either tenant improvements, a tenant walks in and he'd rented, but he'd like you to fix it up. You have to have money to fix it up. And the second thing that they're going to want is, in order to lease the property, you have brokers, you have other fees that you have to pay, so they want you to have in reserve money always in order for you to be able to accomplish a new rental. That's in a new acquisition. The construction loan works differently. The bank walks in, you give them your plans with your architect, your engineers. They come up with a plan of building, and they will advance you the money as you're advancing in your construction. They will have retainage. Usually it's about 10%. They're going to hold back until you get the C of O. And it's a little bit difficult because the bank is constantly monitoring it, and you have to report to them what percentage of the construction is completed, which is going to be the same percentage applied to the amount of loan that you're going to get. Bridge and hard money loans. This is somebody that cannot qualify for a bank right now, but he'd like to buy this building. He will get a bridge loan from an institution who's willing to do it, or a hard money loan. I've always been against hard money loans because it's quite expensive. For instance, on a loan today, they would want a point going in, a point going out, and anywhere from 8 to 15% interest. Sometimes some of them want the interest be paid up front for the year, and it usually lasts for a year. Now, in one way, a bridge loan or a hard money loan is a good idea. Let's assume you buy a building for $1 million and you need $250,000 of money to get into that deal. I only have $100,000. I have a choice. I can take a hard money loan and pay the interest until I get financing, or take in a partner, a money partner. So now you'll give the guy 50% because he put in $150,000. You get 50% for your $100,000. Now you have a partner who's going to tell you what to do. He's there for years and years and years. He's going to say, well, I put in the money, but you got your money back a long time ago, but he's still partner. You can't get rid of him. So it usually, for a condition like this, it usually pays to take a hard money loan. Look at it this way. This guy's going to borrow $150,000. It's going to cost him a point in and a point out. That's 2 points. That's $3,000. It's going to cost him interest, let's say 10%. It's going to be another $15,000. So it's going to cost him $20,000, $25,000 to get this loan. And guess what? The hard money lender is not a partner. He wants to get paid within a year, tops 2 years, so you don't need a partner. So in some cases, hard money lending is a good situation for somebody who doesn't have enough money. In a commercial real estate, when you go for financing, as I mentioned before with the SBA, if you're owner occupied, the bank is going to look what kind of company do you have. Are you making money? What is your track record with credit and all that? They'll give you the loan based on that. If you are not going to have owner occupied, it's going to be non-owner occupied, the bank is going to look at the quality of the tenants that are existing and the future tenants that are going to come in. So they're going to evaluate, not you, because you're not using the building, they're going to evaluate the tenants that come in. Another thing, the bank does a credit check on you and on your company, and I don't know what kind of investigations they do. You got to be very careful that you don't have any liens on your name. Sometimes you get a bill from New York State for not filing a certain return of an entity that's long out of business. They assess you $1,000 penalty for not paying. 2 years go by, you didn't pay it, they slap a lien on you. And likewise, there can be liens put on by people you don't even know. It's a small amount of money. Guess what? When you file an application for a loan and they do this check and they find out that you have all these liens, some banks say, if you neglected to pay these little amounts of money, even though they didn't neglect it, they didn't know, we don't want to do business with you. So make sure once in a while to do a credit check on yourself or on your company to know whether you have liens and you should clean them up. And as I said before, make sure that all your tax filing and registration filings are all up to date, because it can hold up a closing or it can lead to a disapproval of the loan if you don't do it. What you should be looking for when you go to a bank to get financing. So there are certain terms that you should know. First thing is personal guarantees. The bank usually would very much love to get your personal guarantee. It's not I'm quoting them. It's not that they're going to go after you or your wife or your house. That's not what they're looking for. They want to make sure that when things go wrong, you stick around. You don't run away to another state or another country. they want to know that you have skin in the game. That's the personal guarantee. In some large deals, there's a limited personal guarantee. It could be the top 20% of the loan you're only responsible for. You got to be careful what kind of guarantee they want. They would also want, if you're in business and you're buying a building for your business, they would also want a guarantee from the corporation. And if you have another business or another corporation, they would like to get it cross-collateralized, which means that the second corporation or LLC is responsible for the company owning the building. It's cross-collateralized. If you do something wrong in one, calls the loan even though the loan wasn't given to them. Then the bank is going to want financial reporting, which we're going to get into, and then to talk about what kind of interest rate methods the banks have. I'd like to throw out a question for the audience, and let's see what you say. What do you think the first thing you would consider when looking at a bank's financing proposal? Anybody? Rate? Anybody else? That what they want as collateral? Okay. Most of you are probably thinking rate. I would use that the last thing. It is the least important because rates you can always compare. There are other hiccups here. For instance, what are the terms? In other words, how long am I getting a mortgage for? 5 years, 10 years, 7 years? What is my amortization? Means you're going to amortize it, not necessarily over the term of the mortgage, but also at a much more years. So, for instance, you might have a 10-year loan with a 25-year amortization. What happens after 10 years? You're left with a balance. If the bank doesn't want to renew, it's called a balloon, and you have to pay that. But all these conditions that they have, which we'll enumerate a little later, if you don't keep to these conditions that the bank wants, reporting, all kinds of ratios that the bank wants, I found out the hard way that, let's say you blow a covenant, it's called. You're supposed to have a debt service coverage of 1.25 to 1, and it's only 1.10 to 1, the blow coverage. If the bank wants to be tough, they say, you are in default of the loan, we are calling the loan. Until you pay the loan, we're hiking up the interest rate to a default rate, which sometimes could be as high as 24%. In other words, when you're having problems, they tell you, not only don't we want to help you, but we're going to sock you with more interest. And on top of all that, I've had this occasion, the bank is going to say, since we're asking you to pay back this loan, you are prepaying the loan. And if you are prepaying the loan, you also have to pay the prepayment penalty. And those that are in real estate will find out that in the early days, prepayment penalties could be millions of dollars. So you could default on a covenant. You have to pay 24%, up to 24% in interest. You get a bad reputation, and you get a prepayment penalty. The banks also make sure that if the building is making a profit, that you don't schlep out all the money and leave the company without any money. So they have covenants that protect that. When a client asks me to get involved with a loan, the most time I spend is on the covenants and on the reporting requirements. Rates is something a half a point up, a half a point down. It's not going to make or break the deal as far as I'm concerned. The mistake that people make, I'll give you an example, insurance. You have an insurance policy, you're talking to your friend, he says, you have insurance? Yeah. For how much are you insured? $1 million. What do you pay? $1,200. Oh, I have a company that $1 million is only $800. Okay, I'm going to that company. That's a big mistake because there's insurance and insurance. there's conditions in the insurance. You cannot compare pricing. It depends what you get. So I make sure to negotiate very, very hard on the covenants. Most of my time I spend on covenants, which is the most important thing. If you get good covenants, the chances of you not defaulting are far better because they're easy covenants to meet. And by the way, if you have broken a covenant and the bank said, okay, we're going to let you go this time, make sure you get a waiver, a written waiver for them, so tomorrow when there's a new bank officer, he can come back to you and say, you broke the covenant. As a matter of fact, our policy in the firm is that if somebody defaults on a covenant and the bank says, okay, we don't issue the financial statement until we get in writing that the covenant has been waived. And we put into our financial statement for disclosure that this particular client has broken or hasn't met one of the covenants, but the bank has waived the covenant for this year. So the first one is debt service coverage. And if you look at it, debt service coverage means on the left side is the cash availability that the business has. It consists of the profit plus the interest plus the depreciation plus the amortization. That's what's used for cash flow. In other words, even though depreciation is an expense, it's not a cash expense. So let's say in this particular thing, it's $125,000 as compared to the mortgage payment, which is principal and interest. In this example, it's $100,000. So it's $125,000 over $100,000. That's 1 1/4 to 1. In most standard real estate, you could expect that the bank is going to want 1.25 to 1 as a condition. We try to bring it down to 115, 110. We've done some deals 1 to 1 for various different reasons, but this is one thing. The other thing is current ratio, which is assets as compared to current liabilities. That's not really applicable in real estate. It's only in businesses. Another one is minimum tangible net worth. They want you to keep a minimum amount of equity in the business, and I'll explain to you in a minute why this covenant is put in. Now, just to discuss how would any of these covenants affect the amount of distributions, now here's what you look at. Let's assume you look at tangible net worth. What's tangible net worth? Usually the capital that you have in the business. If they say you have to have capital of $1 million, you have profits, and you take out $500,000, even though you only had profits of $200,000. Guess what? Your capital account goes down, so it doesn't meet the minimum tangible net worth. That keeps you making sure that that minimum is there, and they're very strict about it, especially in businesses. Okay. Then we also have the debt service coverage. Again, like we said before, profits and depreciation, interest, numerator, as compared to the denominator, which is the mortgage, interest, and principal. It's the profits minus distributions. So if you take out too much distributions, you're not going to have 125,000. You'll have, let's say, 75,000. 75,000 to 100 is 0.75. It's not 1 1/4, and you broke the covenant. So that's how they control you. The debt equity, which is how much debt you can have as compared to the equity that you have in the company, that can run anywhere from 2 to 4 times. That means you can have 2 times the debt. You can borrow 2 times as much as you have in the business. If you pull out money from the business, you have less in the business. Therefore, the debt is a higher percentage. You break a covenant there. So these are the covenants, which to me is the most important. The second one is the financial reporting. What does the bank require that you report? First, they want financial statements. What is the period that they're looking for in financial statements? Do they want annual? Do they want semi-annual? Do they want quarterly? Do they want monthly? Some banks in real estate want to see a monthly. Some banks, even in businesses, want to see a monthly. It's really a pain in the neck to prepare that because usually the client themselves can't prepare it, and if they do, it comes right out of QuickBooks, and it doesn't look good. It's not presentable, and it doesn't really tell the picture. Sometimes it tells the bank how disorganized you are by looking at the QuickBooks that you have. So you have to negotiate that also. If you have, let's say, a 60-day period from the semi-annual that you have to report, and you don't give it to them in 60 days, they could say you're in default, and we start all over again. But if the accountant has a relationship with the bank, call up and you say, well, it's tax season or Pesach or Purim, whatever, give me another 2 weeks, and they give it to you. Once they accept the financial statement, you don't have to worry about that. Then you have to worry about not only how frequently you give it, you have to worry about what kind of financial do they want. The lowest is a management internal report, what I said from QuickBooks. Then you can have a CPA compilation, you can have a CPA review, and you can have a CPA audit. Usually in real estate, a bank would want a compilation together with the tax return. That's what they would usually want. They would want rent roll reports also, periodically. They would want tenant occupancy reports in order to determine the vacancies. They'd like to have the tax returns. And in tax returns, they say within 15 days of filing. Because the bank knows most people don't file by April 15th, so you can't force them to do that. So whenever you file it, within 15 days you have to give. And whether you give a personal guarantee or not, the bank would like to see your personal financial statement from year to year. Because looking at your financial statement, let's assume you're a gambler and you had $5 million in cash last year, and this year you have $500,000, the bank is going to ask what happened with the $4.5 million. And that's how they'll discover whether you're running a straight life or you're doing some hanky-panky. So these are the reporting requirements and the covenants. Now we get to rates. See, rates you could compare. You can tell the bank, well, you want 150 over LIBOR or whichever way they do it. Let's assume it's 4.5%. The bank down the street offered it to me for 4.25 or 4%. You can haggle that way. As long as you have all your covenants and everything done, the rate is not as important as the other conditions. And again, as we said, how long are they going to keep that rate? Is it a variable rate? Is it a fixed rate? If it's a fixed rate, for how long is it fixed? Obviously, the longer they fix the rate, the more expensive it is. In today's times, I advise clients take the longest amount. If you can get a 10-year fix, rather pay more. We don't know where it's going to go. If I don't want to play politics, although I love it to play politics, I can talk about it all day. If there's a change in administrations next year, it's going to affect the interest rates a lot. And people that own real estate should know if you buy something at a 5 cap, what are you going to do when it becomes an 8 cap? You're not going to be able to sell it. So you get the rate, the mortgage amortization. You have to know what the balloon payment is going to be at the end, because at the end of 10 years, the bank says pay up. If the bank doesn't want to renew it, you got to go out and get a mortgage. If you don't get a mortgage to pay off the first bank, again, you're in default. So if you're in default, there's prepayment penalties. Now, what kind of prepayment penalties? There is what we call a 5-4-3-2-1. In other words, some banks, the smaller banks, will say if you pay it back the first year, it's a 5% penalty. The second year, 4%. The third year, 3%, 2%, and then the rest of the term, 1%. I like that because it's fixed. You know exactly what it is. Now, you might want to pay it back because a customer, a buyer comes along and gives you an offer that you can't refuse. You want to sell it. You have to calculate what the prepayment penalty is going to be. Then you can do a swap. It's very, very complicated. And you need, when you do a swap deal, you need to get an attorney that specializes in swap documents, because even I don't understand how it works, because there's a lot of potholes you can fall into. But the banks tell you that if interest rates go up and you pay off the loan, not only will there not be a penalty, but you can make money. That's how swaps work. If the interest rates are down from when you borrowed, you have to pay up the difference. If the interest rates are up, they pay you the difference between the interest rate that's in effect the day you pay back the loan versus the interest rates that you committed yourself to. Then there are bank fees. Banks charge points, half a point, a point. You have servicing costs. Some banks charge a servicing cost for every year for their servicing the loan. Then you have mortgage broker fees, which you should also know. That you go out to a mortgage broker, that I favor because they have a lot, they go to many banks at the same time, but it has a cost. It can run anywhere from a half a point to a point. So summing this up, I'm asking again the question, what do you think the first thing you would consider when looking at a bank's financing proposal? So again, as I said, you look at the covenants, you look at the reporting requirements, and you look at the rate. The rate is usually one sentence that they charge you the rate. I sometimes, and I shouldn't say this loud, I sometimes leave the rate till the end. Let me tell you why. We go through a term sheet that I negotiate all the covenants, make the bank work back and forth. I want this language, I want that language. We also negotiate, try to handle down how we're going to report to you. Now we're at a stage where the bank put in already a lot of work. If I would go to them and ask them on a term sheet, what is the rate? They will tell you this is the rate and goodbye. So I do it in a way where I have them invest time. So they're a little bbit more negotiable on rates at that time. Rates is like in the olden days when you needed a branch, the first thing people asked is, where's the nearest branch? And I used to tell people, what difference does that make? What kind of bank, what are they giving you? You have to send the deposit by messenger, send it. That's the least question that you should ask. A relationship with a bank, which is very, very important. There's a saying, and I'll quote it, maybe I'm paraphrasing. Banks are like someone lending you an umbrella, but wants it returned when it starts raining. Banks are going to give you money when things are good. And when things turn a little bit sour, they're going to take away that umbrella. They're going to use it for themselves. So it's very, very important. If you develop a relationship with a bank, you have who to talk to. So the things that are going to help you have the relationship is you have to understand that the bank is in the business of lending. They want to lend. They're not doing you a favor, but they want to be secure. They're in the business of lending money. They like deposits, but what do they do with the deposits? They lend you money. Just as an aside, my office is near Borough Park on 60th Street. I counted that from 39th Street to 65th Street on 13th Avenue, there are 21 banks in Borough Park. I don't know how it's in Flatbush. I'm sure there's a lot of banks there. So, what was his name? Houghton. Willie Houghton used to say, why do you rob banks? Because that's where the money is. I guess in Borough Park, that's where the money is. I was talking to a bank last week, and he told me that on that strip, it's public information, there is over $1.5 billion with a B deposits. That's not real estate. That's cash deposits laying in the bank. You got to make sure that if you get a loan, you use it for what the bank asked you to use it. If you get a loan to fix up for a tenant or to buy inventory and you use it to pay your tuition and the bank sees you took out the money, that's a no-no. And you have to communicate with the bank, good or bad. I'm leaving the last thing, and I want to tell you a sideline. Banks never react well to surprises. In other words, if you issue a financial statement showing a big loss or a big reduction in profits for the year ending 2018, you give it to them in April or May, bank is going to be very mad because you surprised them. They thought everything is hunky-dory. If you surprise them, the ramifications could be terrible. I've gone through in the last 2 years with 1 or 2 clients where they lost money and we gave them the financial statement on time, meaning by the end of March, which we usually do, and we showed a loss, and they didn't give it to the bank until July because they were afraid of what the bank is going to say that they didn't give that if they see this loss. First, they wanted to blacklist the accountants because the client said, well, I just got it. First thing they do. Well, lucky for me, there's a date on the opinion page. There's a date of when this financial was done, and I was able to prove to the bank that it was done in March. As a side note, to end this topic, people have always asked me, and until about 5 years ago, I didn't know the answer. And I wonder what the audience thinks. Is it better to be a small fish in a big pond? In other words, you take $1 million, $5 million loan in the Chase Manhattan Bank or in a TD, or is it better to be a big fish in a small bank, in a small pond? In other words, you go to one of these small banks. If anybody is here listening, I don't want to call them small, but let's say a Signature, a Dime, these smaller banks, not national banks. Which way is it better? Am I better off going into a place where your loan is minuscule compared to what they give, or am I better going into a small bank? Does anybody have an opinion? Why? Okay. Anybody else? Yeah?
The bigger bank, there'll be more flexibility because you're the first bigger client, or potentially that's the level of work.
You mean a smaller bank?
Smaller bank.
You're right. Right. Anybody else have an opinion? Pardon?
A risk will be heavier on the balance sheet.
Yeah. Okay. I'll tell you how I reached my conclusion. When a business, for whatever reason, is on the brink of closing down and you owe them money, my experience shows that the large banks are very, very vicious. I'm going to use that word, vicious. What do? The minute you something is going wrong, corporate says, put it into workout. Workout is a dirty word. That means they will take your entire file, that's by your loan officer who's been there 10, 15 years, and take it away from him, give it to somebody in some office, not there, it could be in Connecticut, in Delaware, it could be in Jersey, whatever, and they deal with you. You cannot even communicate with your loan officer. So he looks at you as a piece of paper. He doesn't care how much money the bank made on you. He doesn't care what a nice guy you are. He doesn't care how many Hanukkah parties you invited him. He doesn't care how many customers you referred to the bank. His job is to get paid. And they hire the right people that know how to give you such a hard time that you say, let me do whatever I can, pay them off because they're not going to leave me alone. However, in a small bank, You could even talk to the president of the bank. They look at you as an important customer. A, they don't want to classify the loan. In other words, they want to work it out, because if they classify, in other words, they say it's a bad loan, they have to bring their reserves up. They want to work with you because to them it's important that you send them clients. To them it's important that you're about tzedakah. To them it's important that you've had a clean life for the last 50 years because they asked the neighbors. And that's why it's much easier to work with the smaller banks if things go bad. So when a client asks me, what do you think? I say, do you think you will ever perform not well? No, with God's help, everything will be fine. But I said, listen, in the 70s, things went down the tubes. In the late 80s and early 90s, things went down the tube. And, you know, people can't know. The sweater line, the knitting line went out of business. The appliance stores, whatever, went out of business due to Amazon. So things can happen. If you're so optimistic, stay with a big bank. Does anybody have any questions until now? Because I want to discuss two more topics that are not so much with banks, but is the newest thing that's important for people in the real estate industry to know. Anybody have any questions? Yes.
None of the requirements, the covenants, come almost to the end, either of the commitment letter or a lot of times in the loan documents, and you have to close in a few weeks, and not so much time.
I wouldn't look at a commitment, at a term sheet without covenants.
The banks a lot of times make
Too bad. Don't go to that bank. You're not going to be forced to sign. I had a case where a client has two distinct businesses. One has nothing to do with the other. The second business, he has one business that he finances. The second business is an altogether different business. And he found some mortgage broker, little mortgage broker. He got him a loan. And I knew he's not good because they got the loan without asking me one question or the accountant one question. And lo and behold, at the closing, we find out that what he let my client sign is a cross-corporate guarantee. In other words, the first business has to guarantee the second business. Okay. But in order to do that, you got to get permission from bank number one. You can't guarantee someone else's loan. We're giving a loan to bank number one. The bank did not want to let the client give a personal cross-corporate. At the end, they relented, and what we had to do is get a cross-corporate guarantee from the other business. So both had cross-corporate guarantees. The bank number two wanted quarterly statements. They only wanted semi-annual statements. They also wanted quarterly statements. And it was not a good situation. Had this guy asked me, given me the term sheet, I never would have allowed that to happen. Anybody else? Yeah.
On non-recourse loans, where the bank today still looks at the personal information. Do you have experience how it works with syndicators? The syndicator has a bunch of investors behind their name from overseas. What do the banks look at?
If there are syndicators, there's got to be somebody strong enough to guarantee the loan. The fact that you have 10, 15 investors, they don't want from all the investors because they're limited partners. They would want to have it from the most net worth partners. They might, even if they don't require a personal guarantee, there's the good guy clause. In other words, there's certain things that even though there's no personal guarantee, there still is. Let's say fraud. Or let's say you pocketed money from rentals and you didn't pay the bank. You're responsible for that. So they want to have somebody on the hook. There's always somebody. That's what the syndicator is getting paid for. If he gets 30, 40, 50% of the deal, it's not only for bringing the deal. He is the one that the bank knows. He is the one with the reputation. I only have a few more minutes, so I want to discuss two topics. And they're both really very, very current. And that is, there's a new tax law that came out that really affects real estate in a very negative way. It's Section 163J, whatever that means, and it's called the business interest limitation. Here's the way it works. If you have an EBITDA, which is earnings plus taxes plus interest plus depreciation and amortization, that's EBITDA, that's called the net income of, let's say, $1 million. You can only deduct $300,000 in interest. So if you have a business that borrowed $20 million and you only made $1 million, even though your interest expense is $600,000, you can only deduct $300,000. What happens with the other $300,000? You can carry it forward to next year. But if you have the same problem next year, then you have 2 years to carry forward. 2 more hours? What are you saying? Okay. Now there are exceptions to this rule. One exception is if your average sales for the last 3 years is below $25 million. That means if you only have revenue sales of $20 million, there is no, that 30% limitation is gone. So the smaller businesses don't have to worry about it. What happens with real estate? Very few people in this room, I don't think there's anybody in this room that has a piece of real estate that has rental income of over $25 million from one entity, right? Anybody have that? This limitation is still in effect. How? The rule is that if you syndicate out more than 35% of the building, in other words, the syndicate, the guy running the show, has a 30% stake, and all the shareholders have 70%. You are considered a tax shelter, and therefore the $25 million exemption does not exist. So in real estate, in most cases where the guy running the show doesn't have 65% of the deal, the $25 million exemption does not hold true. However, the government gives you a loophole and says, if you elect not to depreciate quickly, and I'm not going to go into what that means, forever, we're going to let you take off the interest. We've done a lot of calculations on various deals. Right now, for many, many different reasons, I take the position that it's better to take the interest and forego the accelerated depreciation. So this is a very important thing that can affect, if you guys are getting K1s, you will see there is a certain line which tells you how much of the interest is not deductible. You got to add it back to income. The last thing I want to say, everybody knows what QOZ is, the opportunity zones. I'm not going to talk about opportunity zones, but you should know that the government just came out a month ago with regulations. New regulations, and they're going to come out with even more new regulation. The regulations that they came out with a month ago is very, very favorable to the taxpayer. In other words, I'll give you a quick example. Up until now, the QOZ, the tax breaks, only was if you bought a building. They let you even lease a building. Up until now, you can only do the transaction with a non-related person. They let you do with a related person in order to, if you get the market rates for all this. So you should ask your accountant of what the new regulations are. I think there's going to be another few regulations to make it smoothly. But one thing you should know, it's been so successful, this program, prices in some areas are skyrocketing for buildings, for projects, because so many people want to get into it. And with this, I want to leave you with my last slide. May you all have lots of atzlacha in all your future endeavors. I thank you all for listening. It's been a pleasure. Thank you very much.